Tonight, the world didn't shift because of a war, a vote, or a viral headline. It shifted because China just opened a gold door that bypasses the dollar. At 9:37 a.m. in Beijing, officials spoke for minutes, and in that calm, bureaucratic tone, they basically told every central bank on Earth, you can move your gold out of the West and plug it into Shanghai. I'm John A.G., and this is Silver&Golden Signal Lab. Now let's break down what actually happened, why it matters, and why this move hits the U.S. dollar in the one place it cannot defend. Trust. Because here's the trap most people are falling into. They think gold storage is boring. They think it's just logistics. They think it's another China wants influence headline that fades by next week. No. This is infrastructure warfare. This is financial World War II, and it doesn't start with tanks. It starts with vaults, settlement rails, and reserve managers quietly doing math behind closed doors. China just made an offer, not to retail investors, to the people who sit at the top of the money pyramid. Sovereign wealth funds, central banks, the institutions that decide what safe even means. The offer is simple on the surface. Store gold inside Shanghai-based vaults, pay fees, settle transactions in renminbi, and get a package of Western-style protections, allocated bars, audit access, insurance language, and repatriation terms. But under the surface, it's not storage, it's a doorway. A doorway that lets countries move their metal out of New York and London, reduce dollar exposure, and shift official reserve activity into China's financial plumbing. And once that happens at scale, the dollar's network effect starts to crack. And don't forget, subscribe to support the original work. And if you're part of the movement against copycats, comment John A.G. best so I can see you. Now stay with me, because once you see the mechanics, you'll understand why they announced it like paperwork on purpose. Because when a system wants to change reality without triggering panic, it always uses boring language. China released the announcement in English at the same time as the domestic version. That detail matters. They weren't talking to their own citizens. They were talking to foreign institutions. And the world they're talking to has one fresh scar: 2022. 2022 was the year every reserve manager learned the same lesson. If your reserves sit inside a Western jurisdiction, they can be frozen, blocked, sanctioned, or weaponized. You don't have to like the target to understand the message. Your assets are safe until they aren't. So what do central banks do when the rules change? They don't tweet. They diversify. They quietly build escape hatches. And China just offered the biggest escape hatch we've seen in decades. Now, if you're not deep in the weeds of bullion mechanics, you might miss how surgical this is. So I'm going to explain it like a battlefield map. The Western gold system has two faces. Phase 1 is real, allocated, physical bars with serial numbers and segregated storage. You can point to them, you can audit them, you can move them. Phase 2 is unallocated paper claims, pooled accounts, layered contracts, and rehypothecation risk hiding in the shadows. In normal times, both phases coexist because nobody wants to ask uncomfortable questions. In stress times, everyone asks the same question at once. Is my gold really there? China's offer is built to weaponize that anxiety. They are advertising allocated, segregated, bar-by-bar storage, not vibes, structure. They are basically saying, if you're worried about paper games in the West, bring the metal here where the bars are yours and yours alone. Now add the next layer, auditing. If you're a sovereign entity moving billions in gold, you don't accept a spreadsheet and a smile, you demand verification, China is offering audit procedures, physical counts, weight checks, purity confirmation, the boring detail that becomes extremely exciting when trust is the currency. Then insurance. They included insurance language designed to neutralize the fear of seizure and loss. They're trying to look like a safe alternative, not a gamble. Then repatriation. This is the silent killer feature. Because the entire point of storing gold is that you can get it back when you need it, and the world remembers debates over repatriation timelines, delays, excuses, and awkward headlines. So when China says define delivery rights and timelines, they're not offering convenience. They're offering psychological relief. Now combine those elements: allocated metal, audits, insurance posture, and repatriation terms. That package is not accidental. It is a credibility weapon. But the real weapon isn't the vault. The real weapon is what sits underneath it: settlement. Because China isn't just saying store gold here. China is saying store gold here and settle the flows in renminbi. Fees, contracts, swaps, liquidity facilities, all connected to gold collateral sitting inside Shanghai. This is how you build an alternative reserve ecosystem without declaring a formal gold standard. This is how you create a new lane without screaming it into the microphone. And this is the point where the dollar starts sweating. Because the dollar's dominance is not just about GDP or habit. It's about network effect. The world uses dollars because everyone else uses dollars. That loop is the moat, but moats can drain. If enough major players start doing even part of their reserve activity outside the dollar, the loop weakens. Not overnight. Slowly, and then suddenly. And it's that slowly then suddenly pattern that traps people because they stare at today's calm and assume tomorrow is the same. China didn't do this in a boom. They did it when the world is fractured, when sanctions are normalized, when supply chains are political, when trust is already broken. Now here's the part that makes this a financial WW2 move. China doesn't need to replace the dollar tomorrow. They just need to create a credible alternative lane. Because once an alternative exists, cautious institutions start hedging. And hedging is the first crack. A central bank doesn't have to declare anything. They can move 1%, then 2%, then 5%. They call it risk management. But the market reads the same message. The monopoly is ending. And once the monopoly narrative breaks, pricing changes. Now here's where the media lies to you. They'll tell you this is symbolic. They'll tell you the dollar is too big to fail. And in the short term, they're right. Big systems don't flip in a week. But that's also why they're wrong. Reserve systems don't collapse in a week. They erode, they leak, they lose share until the confidence that held them together snaps like glass. And when confidence snaps, the repricing is savage. So let's map the cascade, because the cascade is where this turns from interesting into oh no. Stage 1, quiet calls. A handful of countries start asking questions. What are the legal protections? Who insures it? How fast can we get it back? This stage is invisible to the public, but it's real. Stage 2, pilot transfers. A smaller central bank moves a portion. Not enough to trigger panic, but enough to test the pipeline. The paperwork gets processed, the bars are logged, the audit is done, and then the key part, nothing bad happens. That nothing bad happened becomes permission. Stage 3, a big name moves. And once a big name does it, the lane stops being theory. It becomes precedent. Then stage 4, trade linkage. This is the nightmare scenario for the dollar, because gold storage becomes a foundation for settlement agreements. Even if it's 10% of trade, marginal demand is what matters. Reserve currencies live on steady marginal demand for their assets. Treasuries, deposits, dollar liquidity. If that marginal demand weakens, yields rise. If yields rise, borrowing costs rise. And if borrowing costs rise inside a debt-heavy system, the pressure becomes unbearable. Now the US has a choice, and both choices hurt. Keep rates high to defend the currency and strain the debt, or cut rates to protect growth and strain confidence. Either way, you get volatility. Either way, you get pain. And here's the detail that makes this feel like a trap door. The US can defend the dollar's price with interest rates. It can defend the dollar's liquidity with swap lines. It can even defend the payment network with pressure, sanctions, and rules. But it cannot defend one thing: permission. Reserve currencies don't stay reserve currencies because they are strong. They stay reserve currencies because the world believes it is safe to hold them and safe to use them. The moment that belief becomes conditional, reserve status becomes conditional too. And sanctions made it conditional. Sanctions told the world, your access is political. And once access is political, every country starts building a backup plan. That's not ideology, that's survival. Now imagine you are a central banker in a country that is not a guaranteed enemy, but also not a guaranteed friend forever. Your job is not to win arguments. Your job is to keep your nation's balance sheet alive through the next crisis. So you ask a brutal question. What happens to my reserves if I wake up on the wrong side of a political line? Before 2022, that question was theoretical. After 2022, that question became operational. That's why this Shanghai Vault move isn't just a China flex. It's China selling insurance to the rest of the world. And the currency being packaged with that insurance is renminbi. Now here's where it gets even more aggressive. If gold is sitting in Shanghai, and if trade invoices begin shifting into renminbi, then gold becomes collateral for trade in the same jurisdiction as settlement. That reduces reliance on Western intermediaries. That reduces exposure to Western choke points. This is how parallel systems win, not by being perfect, by being good enough, politically safer for the user, and ready when the next crisis hits. And the dollar's biggest strength is also its weakness. The system is so large that it needs constant foreign participation. It needs constant global recycling of trade surpluses back into U.S. assets. It needs constant demand for treasuries to keep the cost of money stable. So if foreign institutions start saying, we'll buy a little less, it matters. Not because they hate America, because they love optionality. Let's get concrete. When exporters receive dollars, they recycle those dollars into dollar assets. That's part of how the system stays balanced. But if even a portion of future settlement shifts into renminbi, then less money gets recycled into U.S. assets and more money gets recycled into a different pool. That is the quiet erosion mechanism. No drama, no collapse, just flow. And flow is everything. Markets don't wait for the last domino. They front-run the trend. The moment investors believe official flows are shifting, they start repositioning. They buy hedges. They buy hard assets. They price a weaker currency even before the weakness fully appears. This is why transitions feel like nothing until they feel like everything. And here's the end game in plain language. It's not a single day where the dollar dies. It's a decade where the dollar share bleeds, borrowing costs drift higher, policy choices get uglier, and citizens slowly realize their money buys less than it used to. That is how financial empires lose, not with a bang, with a leak. And this is why gold sits at the center of this story. Gold is the asset that doesn't require someone else's promise. It doesn't need a central bank's signature. It doesn't need a payment system's permission. It just exists. And that's why it becomes louder when trust gets quiet. If the Shanghai lane grows, don't just watch the dollar index. Watch the spread between paper pricing and physical demand. Watch sudden central bank buying reports. Watch new bilateral settlement headlines that seem small. Those are not small. Those are the BRICS. Because once the BRICS stack high enough, the wall appears overnight. And the people who wait for the wall to be obvious are always the ones paying the highest price for safety. If you've ever wondered when history actually changes, it's right here. Quiet policy moves first, then markets, and only later headlines catch up for everyone else. Now let's bring this down into your life. The personal consequence of reserve erosion is not an academic debate. It shows up as price creep. Imports cost more, energy costs more, food costs more, and your salary doesn't magically reprice every week. This is how purchasing power dies. Quietly, while politicians argue about headlines. So here's a question for you, and I want you to answer it in the comments. If you were running a central bank, would you move 0% of your gold, or would you move 5% just to hedge the risk? Because that single decision multiplied across dozens of countries is what changes the world. Now, I want to make one thing painfully clear. China is not offering this because they love stability. They are offering this because they understand leverage. Control of settlement is control of rules. If your trade flows, swaps, and reserve operations run through dollars, you're attached to dollar sanctions risk. You're attached to U.S. monetary policy, whether you like it or not. But if you can do a slice of that activity in renminbi with gold collateral parked in Shanghai, you are building optionality. Optionality is power. Now notice the genius. China didn't announce, we will replace the dollar. And they didn't need to. They just offered an alternative lane with enough credibility that real institutions might actually use it. And once it's used, liquidity grows. Once liquidity grows, usability grows. Once usability grows, more trade shifts. That is how you build a reserve contender. Not by declaring it, by engineering it. Now, here's a subtle point most people miss. China does not need to fully back the renminbi with gold at a fixed price. They don't want that constraint. What they want is an implied linkage. They want the renminbi to feel sturdier because it sits next to gold infrastructure without promising full convertibility. It's flexible, it's strategic, and it's designed to attract cautious institutions. Now ask yourself something uncomfortable. Why would countries trust China? They don't have to trust China more than the West. They just have to trust China enough to hold a slice. Because the point is diversification. And once diversification becomes normal, the slice becomes a trend. Now here's the reason this is dangerous for the dollar. Prestige. London and New York have not just vaults, they have benchmark power, they are hubs. And control of the hub often translates into control of narratives. If Shanghai becomes a major sovereign gold hub, the center of gravity begins migrating east. That's not just finance, that's geopolitics. Now you might be thinking, okay, but the dollar is still dominant in payments. Yes, and dominance can persist for years, even while erosion begins. That's why this is a trap. People confuse dominance with permanence. Trend matters more than snapshot. Direction matters more than today's percentage. Now let's talk the final domino, confidence. If foreign demand for dollar assets softens, the system must pay a higher price to attract buyers. Higher yields mean higher stress, and higher stress forces policy choices that make everyone angry. That's how financial transitions turn into political transitions. So what can you do with this? First, don't panic. Second, don't ignore it. Third, understand exposure. If your entire financial life is priced in one unit, you are hostage to that unit's repricing. Diversification isn't fear. Diversification is policy. This is how reserve managers think. They hold options. And in unstable periods, optionality beats perfect forecasts. And here's the cliffhanger you need to sit with. The vault story is not the end, it's the start. Because once you build a gold settlement lane, you can attach other systems to it, commodity contracts, trade invoicing, credit facilities, and then you don't just store gold. You become the hub, so watch the next signals. Not the speeches, the contracts, the swap lines, the official reports. Nobody reads until it's too late. because the first place you'll see the next phase isn't a press conference. It's a trade deal written in a different currency. Now, if you've ever protected yourself during inflation, share what worked for you in the comments. Not to brag, to teach. And if you want clear updates like this without fluff, make sure you're subscribed. Most people watch and never subscribe. If that's you, fix it now. One click, done. Now let me summarize the core message in one sentence. China offered the world a new lane. Store gold in Shanghai, audit it, insure it, move it, and settle official flows in renminbi. That's not a press release. That's infrastructure. Infrastructure changes behavior. Behavior changes flows. Flows change prices. Prices change politics. And politics changes everything. So answer these two questions below. Do you think major central banks will actually move meaningful gold to Shanghai? Or is this all posturing? And if you had to hedge one thing right now, currency risk, inflation risk, or interest rate risk, which one would you prioritize and why? I'm reading every comment. Take care of yourselves, take care of each other, and I'll see you in the next video soon.